Hello, guys. This is Vineet from Edge Forex, and today I want to talk about a fascinating concept that many investors are familiar, but only a few understand: how gold climbs the wall of worry. So grab a beer, settle in, and let's unpack what it really means and why is it so important for your investment strategy. So when we talk about gold in the context of investing, one phrase often comes up: gold likes to climb the wall of worry. But what does that mean? Why does gold seem to thrive in times of uncertainty and fear when the other assets are floundering? Today, let's try and figure out what that really means and why gold remains such a critical component of many investors' portfolios, especially during turbulent times like we're in right now. So let's start with basics. The wall of worry refers to the various concerns and anxieties that weigh on investors' minds. These could be anything from economic recessions, geopolitical tensions, inflation, or even pandemics. Essentially, it is all the bad news that makes investors nervous and uncertain about the future. Now, in these times of uncertainty, many assets tend to lose value. Stock markets can plummet, real estate may stagnate, and even bonds might not be as safe as they once were. But gold, on the other hand, often shines. It is during these moments of fear and uncertainty that gold's true nature as a safe haven asset comes to light. Gold has been valued for thousands of years, not just for its beauty, but for its stability. Unlike fiat currencies, which can be devalued by governments printing more money, gold has intrinsic value. It's not tied to any one economy or government, making it a global standard of wealth. That is why when the stock market starts to wobble or inflation begins to rise, investors, they flock to gold. They see it as a way to preserve their wealth when everything else seems risky. Let's take a historical example to illustrate this point. Think back to the 2008 crisis. The world was in turmoil. Banks were failing and the stock markets were crashing. During this period, while many assets were losing value, gold prices soared. In fact, from the start of the financial crisis in 2007 to its peak in 2011, gold nearly tripled in its value. That's a classic example of gold climbing the wall of worry. But why does it happen? Why does gold perform so well when other assets don't? One key reason is inflation. When central banks print more money to stimulate the economy, it often leads to inflation, which erodes the purchasing power of fiat currencies. Gold, however, tends to hold its value or even appreciate during inflationary periods. This makes it an attractive option for investors looking to hedge against devaluation of their money. Another reason is the psychological comfort that gold provides. During the times of crisis, when uncertainty is high, people naturally gravitate towards what they perceive as safe. Gold, with its long history as store of value, offers that comfort. It's tangible, it's been valued across civilizations, and it doesn't rely on the performance of any one company or government or an economy. This psychological aspect can't be underestimated. It's a big part of why gold climbs that wall of worry. So, where does that leave us today? In the current global economic environment, we are seeing a lot of factors that contribute to a wall of worry. There are concerns about inflation, especially in the wake of massive government spending during COVID-19 pandemic. It was absolutely crazy. Geopolitical tensions are rising everywhere, and there's ongoing uncertainty about strength and stability of the global economy. All of these factors are creating an environment where gold could continue to perform well. Investors are looking for safe havens, and gold is once again stepping into the spotlight. But it's important to remember that while gold is a valuable part of diversified portfolio, it's not without its risk. Gold prices can be volatile in the short term, and unlike stocks and bonds, gold does not produce any income. It's a defensive asset. It's meant to protect against downside risks rather than generate huge returns. So as we wrap up, I want to leave you guys with a few takeaways. First, remember that gold's ability to climb the wall of worry makes it a unique and valuable asset, especially in uncertain times like we are in now. It's a hedge against inflation, currency devaluation, and economic instability. Second, while the gold can play a crucial role in preserving wealth during crisis, it's important to approach it with a long-term perspective. Like any investment, it is not immune to short-term volatility. So it's best to consider it as part of a broader, more diversified portfolio. Finally, keep an eye out on macroeconomic factors that drive gold prices, such as central bank policies, inflation trends, and geopolitical events. Understanding these drivers can help you make informed decisions about when and how to include gold in your investment strategy. So I hope you found our discussion on gold and the water very insightful and useful for your investment and trading journey. If you enjoyed this, please consider subscribing to our channel and leave a review or a comment. Your feedback helps us continue to provide valuable content. And do not forget to share this with your fellow traders who might benefit from understanding why gold remains such a crucial asset in times of uncertainty. And until next time, you stay safe, stay informed, and happy trading.